Hey, welcome. Happy Friday. Hope you are looking forward to a good weekend this weekend. Weather looks like it's going to be good, so hopefully you'll be able to get out and do a few things. My hope is that we will get out and get to maybe get some pumpkins or go to an apple farm or something. Do something good with the kids. I was going to watch. I was really uh, typically would want to watch the football game, but after last week's Browns showing, I don't know that I even want to sit down and watch the Browns try to play against the Ravens at this point in time. It's not exactly the most optimistic going into a game. It's kind of got that feel of one of those weekends where we're just not going to do a very good job. So I'm hoping that we can get past that and have an enjoyable weekend on doing some other things. But that's not what I'm here for today. I am here today to tell you a little bit about your 401k, the stock markets, and what's been going on so that you can kind of see and have some idea of what's been happening, why it's been happening, but then also what you can do to best counteract the things that have been happening. So let me go ahead and just get a quick message sent out so that people know we're live and on here. As always, I'll show you the quick disclosures for informational purposes only. If you like any of the things that we talk about, please consult your own financial planner or tax advisor or investment advisor before implementing any of these steps. So let's go ahead and let's talk a little bit about what has been happening in the market. So I'll pull the markets up for today. You can take a quick look. This is kind of how I watch it each day. So let's share this with you so you can kind of see what I look at. Nothing fancy. I look at what you can look at. It's right on Apple Stocks app. So we see today the market is doing pretty well. We can't complain about it. Any update at this point in time is a good day. Kind of makes us happy to see that that's happening. And it's kind of across the board. Twitter is what it is, and this is an inverse, so it's down because the market's up. So it kind of goes opposite of the market. I watch it just for fun, but you kind of see the markets are up. If we look at the S&P 500, the 500 largest companies in America, not the 500 largest, but 500 of the largest companies in America, we can see that today it's gone well. The last month not so well. The last 6 months really not so well, and year to date not so well. So the question we're going to ask is, why are these things happening? Why have we seen the markets come down, and then why in the last 2 days have we seen the markets kind of start to trend back up? Where do we think the market is? But then I'm going to give you 3 tips what you can do and what you need to watch out for in this investing environment so you can make the right choices with your 401k. So in terms of what has been happening, the reason this market has been going down like this is because money. I had this conversation with someone the other day in regards to money is like everything else. There's a supply and demand to it. If there's too much money, people don't want it as much. And if there's not enough money, people want it more. So what has been happening over the last, really probably the last 15 years, we've really seen it, but even all the way back to the 80s, there's been this concerted push to to slow down inflation in the 70s and going into the early 80s. So there was a concerted push then, coming out of that, to bring rates from those 20% rates all the way down to where they have been, approaching zero even. So some of you, if you're old enough and you bought a house in the early 80s, late 70s, you remember 20% interest rates for your mortgages. I've actually talked to people, they stood out in line to get an 18% interest rate because it was coming down to 18. So as interest rates go down, it puts more money in your pocket. This kind of makes sense, right? If your mortgage is $1,000 a month, but interest rates go up and now it's 1,200 a month, it takes money out of your pocket. There's less things you can do. You have less dollars. So those dollars you have, you can do less with them. And because you can do less with them, you're going to make decisions valuing those dollars even more. So you might look at it and say, typically we would go out to eat at a nice restaurant, but because I don't have that extra $200, maybe we're going to go out to eat, but it's going to just be McDonald's. So that same thing has been happening, but in the opposite direction. While interest rates go down, you put more money into your pocket. So raising interest rates take money out of your pocket. Lower interest rates puts money into your pocket. So in reverse, maybe you had a mortgage that was $1,200 a month, but interest rates went down and you were able to go and refinance that mortgage. Now you have $1,000 a month mortgage payment and you're running on your way, you're hurrying, you're on your way out to soccer practice for the kids or basketball or football, or whatever musical instrument they play, or swimming, or any of those things that you do, and you're in a hurry because you just got home from work, they just got home from school, you didn't have time to feed them, so you're thinking to yourself, all right, we're going to run through McDonald's. Well, if you've got an extra $200 a month because your interest rate on your mortgage went down, maybe you're not going to run through McDonald's. Maybe you're going to go somewhere nicer. Now, it might not be a sit-down restaurant because you don't have the time and you're trying to save time, but maybe you're going to go through a fast food place that actually has edible food instead of McDonald's. So obviously McDonald's is not sponsoring this video, and even if we asked them to, I don't think they would. But the interest rates affect you in that way. So now you have that extra $200. The $100 you have at the end of the month is now $300 at the end of the month. So you can be a little less thoughtful about how you spend your money. Well, this goes the same for large corporations. If you're a large corporation, at the end of the month, you have 350 million left over, and then that changes to all of a sudden now, instead of having 350 million left over, you've got 400 million left over. You can do something. You can hire new employees. You can replace technology. You can upgrade your manufacturing capabilities or expand into new markets. Likewise, as interest rates go up and it takes money out of your pocket, maybe that 350 million becomes 300 million, and now you can't expand in those same ways because, that sounds like a lot of money, but big corporations work like us in that they know they're going to have bad months in the future and good months in the future. So maybe they have 350 profit now, but they don't know what next quarter is going to be like. So they want to keep it and put it aside for that downturn. All right. So now it puts them in the same situation that you and I are in. As interest rates go up, we have to think about whether or not we're going to spend more, whether or not we're going to buy the new car, whether or not we're going to go out to eat as often. So do large corporations. They have to think about, are we going to continue to hire? Are we going to continue to expand and create new products, especially growth companies like Apple and Netflix and Twitter? All of these companies were hit the hardest because these are companies that take the money they earn and they reinvest it into new products. Now they're worried that they're not going to continue having earnings to create new products, which means that they may not have a new product to sell, which means they may not be able to make as much revenue in the future. So we kind of see this snowballing effect. Where as interest rates go up, it takes money out of our pockets, so we're not going to these companies anymore. As interest rates go up, their revenue goes down because they don't sell as much stuff, but also their expenses go up because they're borrowing just like you and I. So what we're seeing right now isn't so much in the market, isn't so much the effects of inflation or the effects of what is happening over in Ukraine. It's the effects of what the Fed is doing with interest rates. The interest rate upward movement is 100% what is moving the markets right now. So what we're seeing in the markets over the past 10 months now, because it's October, is as the Fed starts telling the markets, we're going to raise rates, we're going to raise rates, we're going to raise rates, the market says, okay, well, that means profits are going to go down, and the market reacts and goes down. Now, this interesting thing is we've seen these little spikes over the last couple weeks, month, here or there. They cover the summer. We had a good month in the market. We see these spikes, and those are spikes that are happening completely because they think the Fed sees that we're going into a recession. Well, I actually think we're in a recession. But if the market thinks that the Fed thinks we're in a recession, now, right, we're playing that. If the market thinks that the Fed thinks we're going into a recession, then the market is going to react. And the way the market is going to react is by predicting the Fed's movements. And they're going to assume the Fed is going to lower interest rates or at least stop raising them. So the market at that point says, okay, well, now there's a potential that our revenue could start to go back up again because interest rates will be stopped or raised, and that'll bring us out of the recession that we're in. And in return for being out of that recession, we will then also be able to see growth kick back in. So when we see the stock market drop, it's right now at least, it's reacting to the thought that the Fed is going to increase interest rates. When we see the stock market go up, it's reacting to the fact that it believes the stock market is going to lower or stop raising interest rates. That's what's going on. So, in light of all of that and knowing a little bit about what's going on in the market, I think it's really important that what we go to now is think about what do we do? Well, I think as I give you these three tips for what to do right now and going forward in this current market that we're at, I do want you to remember something I said before. The typical market downturn lasts 1 year to 18 months. We're about 10 months into it. So we're getting to that point where we're coming out of it. Now, are we at the bottom? I don't know, but I think so. I think we're either at or near the bottom. So let's go into the first tip. My first tip for you is that inflation is your biggest enemy. While we see the Fed raising interest rates and we think to ourselves, man, I really don't want the Fed to raise interest rates. The truth of the matter is we kind of need it to have done what it's done, and we may need it to continue doing that. The downside is if I'm the Federal Reserve Bank, I am absolutely fuming at our president and our Congress because while they're trying to slow down the economy, the president has gone out and passed some of the bigger spending bills we've seen in a long time in terms of the alleged Inflation Reduction Act, which, by the way, will not reduce inflation one bit. It'll actually increase inflation. So while they call it the Inflation Reduction Act, the truth of the matter is it's the Inflation Increation Act. That doesn't really mean what it meant. What I meant it to mean. The Inflation Increasing Act, we'll call it that. That's what it's really going to do. So what we have to do is we have to recognize that higher interest rates are needed. Lower house prices are needed. My friends, I've got a lot of you that are realtors. You don't like hearing those things, but for the economy, this is really where we need to be going and what direction we need to be going in. So if inflation is your biggest enemy, I want to show you something. Let me pull it up. I've got it on a slide over here. I absolutely love these sheets. JP Morgan makes them. But this is what they call their guide to the market. And JP Morgan's guide to the market gives a lot of just um, really great information in regards to the market as a whole, investing and things like that. But I like their investing principles. And that's the one that I'm going to show you in a minute. This is the one I want to show you right now. What this talks about is the cost of goods, how much money things cost and how expensive they get over time. And it compares it not just to what the stock market does or things like that, but it compares it to what your money does if you're sitting in the bank right now. So if you've got money sitting in the bank, if it's $2, $3, $4,000, keep it. You need your savings and emergency fund. As Dave Ramsey says, you don't need to get a bigger, better deal, a BVD on your emergency fund. You just need to have it there. But if you've got money beyond whatever that emergency fund number of 3 to 6 months is for you that you need to do something with, you want it for a long time, this is going to tell you what you need to do. So right here at this end here, this is showing back the last set of numbers we had was in this, or for the decade. The last set of numbers we have is September 30th. So this shows you if you are in a 6-month CD at a bank or a money market or anything like that, you're probably going to earn about, on average, 0.3%. So you're making less than 1%. At the same time, we look at these lines here. Each of these lines is a different category of spending. This is education. This darker one is your medical expenses. And you've got your housing expenses, and you've got your mainline, what they call headline inflation number at 5%. So if you've got your money sitting in your bank account and you're making, I'm going to round up to 1%, and overall inflation is 5%, that means you're losing 4% every year doing nothing. That means that the dollar you have in the bank today is only going to buy you 96 cents worth of stuff a year from now. So your biggest concern is inflation. So what does that mean? It means you have to be invested somewhere. And there are solutions to where, and we'll go over that in a minute. But you cannot be taking this market volatility and saying to yourself, "Look, this is a bad place for me to be," because if you are, you're losing money. In fact, you have a guarantee that you're going to lose money. Like we can't really guarantee a whole lot in our industry, but I will say if you're sitting in money in the bank for money that you're going to use for long term, you're going to lose out. You really are. And it also means weird things, right? This means really weird situations like don't pay off your mortgage, maybe. It's probably a bad time to take your money and put it into your mortgage. It's probably a bad time to take your money. And if you have a low interest rate on your car, pay off the car. It's never a bad time to pay off credit card debt. It's never a bad time to pay off high interest rate car loans or personal loans. But if you've got a low 3, 4, 5% mortgage or even a 5, maybe even 6 at the high end percent car loan, you might want to put your money elsewhere because those ones are actually that debt is actually making you better off. So inflation makes normal, smart, intelligent moves not as smart all the time. But you cannot let your money just sit on the sideline in light of the inflation that we're facing and that we're seeing. So that's tip number one is to recognize that inflation is your biggest enemy. Don't sit on the sideline. All right. Second tip we have, and we'll jump back to the guide to the markets in just a moment. But the second tip that I've got for you today is that it's more important to spend time in the market than it is to time the market. So time in the market is more important than timing the market. So what do I mean by that? Question everyone always asks me is, well, why didn't I take all my clients out in January? And the answer is really easy. No one's got a crystal ball. And you probably understand that. But it's often hard to recognize that we don't know when the market's going to come back either. It's really difficult to look at the bottom of the market and say, here it is. Now we can look, and I'll show you some numbers in a few minutes and talk about them that tell us that I do think we're at towards the bottom of the market, and I think we're going to see it come back. But we don't know when that's actually going to be. In fact, just like a lot of you, I watch MSNBC, I watch Fox News, I watch these. Um, Not MSNBC. I don't watch that. I'm sorry, I said the wrong one. CNBC. I watch that one. Um, and I watch Fox Business News, and I watch these commentators on TV that talk about the markets. And if you watch them for too long, what you'll find is in one segment, the person they come in that comes in says the market's at its bottom, it's going to rebound. The very next one says no, it's not over. It's going to get much, much, much worse. The truth of the matter is, no one knows. All of us have a natural bent inside of us to either be naturally optimistic or naturally pessimistic. And in the stock market, both of those things are wrong. But I will tell you, if you're going to be wrong optimistically, because the market over the long run does phenomenally well for itself. And I can show you some of the like long-term track records. Maybe I didn't think about pulling the slides up, but if we pull this one up, this is just for the last 30 years, I think, from 96 till now. So what do we got? 20, what is that, 26, 27 years? Like the market does exceptionally well. And what you can see is during the midst of all of these things, we had the dot-com crash right here and right here. We had 9/11 is included in this. We had the housing market crash, but look, the market has done exceptionally well. And I wish I'd have thought about it earlier. I would have, you know what, we'll just Google it because it's an easy thing to find. Stock market mountain chart. And a lot of these will go back, and we'll just pull it up in images, and we'll try and find one that's, like this Market Watch. This is the Dow's history going back. All the way to the 1900s. You see the Great Depression in here. That was pretty bad. No one questions that. You see the second half of the Great Depression. Believe it or not, FDR didn't make things better. He made them worse again. We were doing better, and then he crashed us again. And then you see, 25 years of bad time, 19 years of bad time, 16 years of bad time, 6 years of bad time. But if you look at what you'd have done if you'd just put money in 1896 and left it, you'd have made so many fortunes. So this shows us that, it's hard to know when you're at the top or the bottom, but whether it's the top or the bottom, there's always another bottom coming, and there's always another top. But everything that we have seen is that the next top is higher than the last top. So as soon as we break through this next top, you're going to be excited again. You're going to think the market's back. Well, you've missed so much opportunity to recover. So time in the market is more important than timing the market. So, right, tip 1 and tip 2 are kind of the same. Be invested. Don't leave your money on the sideline. Don't think it's a good idea to just go around with your money sitting in the bank or hiding it under the mattress or hiding it in the curtains, because that's not going to do anything for you. That's only going to make things worse in the long run, because you're going to miss all the opportunities to make up the money that you've lost. And the sad thing is, right now, when we're approaching the bottom, when everyone wants to get out. This is my favorite chart of all time. The mountain chart's a great one, but I love this one because people will ask me, what's my money going to be like? How much should I make over the next year? And I want to show you that the answer is I have no clue. If you give me 1 year, I can't tell you what's going to happen. But if you give me 20 years, I can show you what is going to happen. And I can tell you what's going to happen. And in doing so, we can do a really good job of, sorry about that. In doing so, we can do a really good job over a long period of time to give you a good forecast of the future. So we're going to look at just the green bar, right? Green bar is stocks, the blue bars are bonds, and this gray bar is half bonds, half stocks. So let's just look at the green bar because it's the biggest and the easiest one to see this principle. So if you give me $1,000, or just say this, make it easier. You give me $100 today and say, I want it back in a year. I can return you historically somewhere between $147 and somewhere between 61. That's a huge range. Like, it's going to be really difficult to know because we're going to go up as high as 47% and down as low as 39%. It's going to make it very difficult to know what's going to happen in a year. If we can go all the way out to 5 years, just 5 years, then what happens is, on an average annual rate of return, stocks' worst period between 1950 and 1921, their worst 5-year period was a 3% loss. Right? And that took place during the 2007-2009 crash. It's the worst 3-year period, but the best 5-year, I said 3, I'm sorry, 5-year period, the best is 28%. So if you have money that you need in the next 5 years, keep it in cash, keep it in something safe. But if you have more than 5 years, then you can start doing something with it. All right, let's look out even further, 10 years from now. If you give it money and I say, I don't need it for 10 years, just like saving for college for your kids or the last few years of retirement, the worst 10-year period over these 71 years, the worst 10-year period was down 1%. And again, that was the 2007, 8, 9. They ended in probably 2009, probably when that one ended. Now, here's how this works. Rolling 10-year periods, we think to myself, well, that's only 7 periods, but it's not. Because it's 1950 through 1960, 1951 through 1961, 1952 through the start of 1962. So 52 to 62, then 53 to 50 to 63, and so on. It's called rolling periods. So actually, in that time period, there's going to be 71-year periods. There's going to be probably about 40 or 50 5-year periods, and probably around 30 to 40 or maybe more 10-year periods. This is where the magic really happens, though, because if we go all the way out to this 20-year period, the worst 20-year period has a 6% gain per year. That's not 6% over the whole 20 years. That's 6% compounded per year. The best, 17%. So if you can give someone and give your investments as much time as possible to grow. It doesn't matter if you buy at the top, it doesn't matter if you buy at the bottom, it doesn't matter if you buy the best performing stock or the worst performing stock. If you just buy a broad index and you're invested for the full period of time, you're gonna make money. It's not about when you're in the market, it's about how long you're in the market. Just don't miss any days in the market. Don't pull out because you get scared. Don't buy in because it's jumping. Just buy in consistently every paycheck into your 401k, into your IRA, into your long-term savings. Just be in the market as long as possible. All right. I can't drive that point home anymore. This is what you absolutely, positively must do. All right. So that's tip 2. All right, we're going to move on, and we're going to talk about now tip 3. Tip 3 is U.S. stocks are in a position to capitalize off of inflation. This is absolutely great point to understand. U.S. stocks are in a good position. And in fact, I think I used the word great a moment ago. I'm going to use great again because I like that. Are in a great position to capitalize off of continuing inflation. They're also in a good position if inflation does slow down and interest rates can either freeze or come back down. They're going to be in a good position to capitalize off of slowed inflation and slowed to no inflation, because that's going to help put money back into either of those two situations are going to put money back into the pockets of the companies that you're buying. So when you buy those companies and the stocks go up, they go up because they're generating revenue and your ownership is now worth more because that company is worth more. So anytime we see something that makes money worth less, then the assets you're buying with are going to be worth more. Just think about it this way. I was talking to someone just this week, a young guy who wanted to understand inflation a little bit better. I'm going to say, think about it this way. I've got here right on my desk an iPad. Now, this iPad, if you were to go to the store and buy it, maybe $300. I mean, I'm just throwing out a number, maybe $300. Now, if there's so much money in the system that I don't want the money, I want the iPad instead, it's not worth 300 anymore, it's now worth 350. Because it's going to take more of your money to get me to give you this, because I don't really want any more money. I have enough. Right? So we see how that works. And likewise, and that's inflation. When they put more money into the system, the supply of money gets too low. People don't want the money anymore. It takes more money to get the stuff away from people. Likewise, when there's less money in the system and money's coming out and you have less money and and I want your money because we all have less of it, now this iPad might be worth $275 because I need your money, so I'll sell it cheaper. This is how inflation impacts us. So let's think about that in terms of the stock market. If companies have more money and consumers have more money, they're going to spend more because they don't want them anymore. So instead of sitting on money, they're going to hire new employees. They're going to increase and create new products, and they're going to put more money into growing their business and generating more revenue. So their stock prices are going to go up. Now, as theirs are going up because they're generating more revenue, they're buying from other companies, and those other companies' stock prices are going to go up. So if we think of General Motors decides we're going to overhaul all of our equipment, now Intel's going to go get some money because General Motors is going to pay Intel for chips. So now Intel's going to have more profit. Now Intel has more profit. They say, we're going to hire some new people. So they hire a whole new department. And now a whole lot of us have more money, and we decide we're going to go buy a new car. So this is the cycle of inflation. And this is the cycle that, if inflation continues, will help the stock market. And if inflation stops and gets under control, then it will help the stock market in another way. It will help the stock market in the sense that interest rates will no longer be going up. So we'll be able to have a good prediction of what interest rates will be in the future and how profits will look in the future, and we'll be able to value our companies properly. Now, there's an indicator in the stock market called a PE ratio. Now, that PE ratio is essentially means profit and expense. And that PE ratio kind of, not profit and expense, price to earnings. The PE ratio, I was trying to type it in there, so when I type, I can't speak, obviously. Price to earnings. It means what's the price of the stock divided by the amount of earnings each share gets. Typically, this PE ratio runs right around 16. The long-term PE ratio for the stock market is right around 16 historically. And in fact, that chart we looked at earlier actually shows it to us. So we'll pull that up again real fast. And if we look, the historical PE is somewhere around 15. And we can look during this period of time where the market is going up. This point right here, it was at 14. At this point here, it was at 15. At this point here, it was at 10. As this number gets higher, it means there's less value. You're paying more for what you're getting. And as this PE number gets lower, you're paying less for what you're getting. So we look in the January, it was at 21. And that's when the market started to go down. Back in 2020, it was at 19. And that's when the market started to go down. That was helped, obviously, by COVID. Back in 2007, it was at 15.1. Not all that high. It's right around average. 15 to 16% is about average. You go back here, 14.1 before it started to have that upward trend. But here in the dot-com crashes, you see it was up as high as 25. Well, now where are we? We're back down around 15.1. We came from 21 to 15. We're not all that far from the historic average. So does that mean that we'll see prices stabilize in the market? I think maybe. As long as companies keep making profits, the prices will stabilize. So it goes back to the question of what's the Fed going to do with interest rates? So tip number 3 is be prepared and utilize the fact that the US stock market is in a really good position for where it should be. Doesn't mean it won't go down more. It might, but in the long run, it's going to go up. So if you see the trend between these 3 tips, your tip 1 was inflation being your biggest enemy. Tip 2 being time in the market, more important than timing the market. And then tip 3, be in the stock market. You're seeing a trend here, and this is the trend. The trend is that the market is where you want to be. Whether you're doing it in your own, whether you're doing it on a 401k, whether you're doing it with an advisor, whether you're calling me for help, it doesn't matter. You need to have your money exposed to things that are going to grow, because if you don't, you're going to lose money over time. So here's the actual tip. This is what I'm going to tell you. 1, don't pull out. Don't take your money out of the market when it's at a low point. It's a bad idea. Don't do it. If you're going to take it out to buy a house, maybe wait. Let it rebound a little bit. Maybe find some other ways to finance that house. Thinking about those things. Don't pull from your 401k to go buy a house because interest rates are high. This is a bad idea. It's making 2 really bad decisions, compounding upon each other to do that. Be invested. So you have to be in the markets. So here's what I want to tell you. Here's you turn it off right now if you don't want to hear. But here's my offer. I do help people with their 401ks, making sure that they're allocated properly and in the right position. So if you're struggling, you're like, I don't really know, how should I be, how much should be in international, or how much should be in bonds, or how much should be in stocks, call me. I have a one-time service. We go over your 401k and any other investments you have. We put them in the right investments for you. Let them go, and you don't have to pay me ever again. You don't have to give me or transfer money. You charge about $500 to do that service. Depending on the complexity and how many accounts there are, 350 to 500. Usually 350 is like one person, just a 401k. 500 is a husband and wife, 2 401ks, maybe a couple 529s or something. It's a one-time service, takes about 2 hours of your time, and we're done. If I can help you out with that, please reach out to me. Let me know. I'll be happy to help. As always, the information in this video is for informational purposes only. Consult a professional before you apply any of my strategies or recommendations. And if you liked this, you found value in it, please go back down, hit the like, and hit the share. Those of you who have been watching, I saw a few of you on. I thank you for your time. Hope you have a great and fantastic weekend.